Diversification is the bedrock of modern investing. But that bedrock has a hidden flaw: correlation is not constant. In crises, it spikes toward one, and your diversified portfolio becomes a single bet. We'll show you the evidence, the mechanism, and what actually works. Modern portfolio theory tells us that holding assets with low correlation reduces risk. The math is elegant: combine two assets that don't move together, and the portfolio's volatility drops. But this logic assumes correlation is stable. In reality, correlation is a fair-weather friend. It behaves well in calm markets, but when a storm hits, it abandons you. The very assets you thought were diversifying suddenly move in lockstep. This is not a rare event, it's a structural feature of financial markets. Let's define correlation precisely. The correlation coefficient, often denoted by the Greek letter rho, measures how two assets move together. It ranges from -1 to +1. A value of 1 means they move in perfect lockstep, 0 means no relationship, -1 means they move in opposite directions. The formula is the covariance of the two returns divided by the product of their standard deviations. In plain terms, it tells you how much of the co-movement is systematic. The classic study by Longin and Solnik, published in 2001, examined international stock markets. They found a striking asymmetry: correlations are significantly higher in bear markets than in bull markets. Specifically, the correlation of extreme negative returns is 2 to 3 times higher than that of extreme positive returns. This means that when markets fall sharply, diversification benefits evaporate. The study is a cornerstone of our understanding of tail risk. History provides painful examples. In 2008, global equities, corporate bonds, and even commodities fell together as the financial system seized up. In 2020, the COVID crash saw stocks and bonds initially move together before central banks intervened. And in 2022, the unthinkable happened: stocks and bonds both lost money simultaneously, breaking the traditional negative correlation that investors relied on. In each case, the correlation of assets went to 1, and diversified portfolios suffered losses as if they were concentrated bets. The 2022 episode deserves special attention. For decades, stocks and bonds had a negative correlation, meaning when stocks fell, bonds rose, cushioning portfolios. But in 2022, inflation and aggressive rate hikes caused both to fall. Bonds, traditionally the safe haven, failed to provide protection. This was a wake-up call: the correlation regime can change, and the historical relationship is not a law of nature. It's a conditional phenomenon driven by the economic environment. Even gold, the ultimate safe haven, is not immune. In a liquidity crisis, investors sell everything to raise cash, including gold. This happened in March 2020 and in other stress episodes. Gold's correlation with equities can spike to positive during such times, undermining its diversifying role. The key insight is that in a liquidity crunch, cash is king, and all other assets become correlated through the same selling pressure. The solution is to think in terms of risk factors, not asset names. Each asset has exposures to underlying factors like economic growth, inflation, and liquidity. The return of an asset can be modeled as a sum of factor exposures times factor returns, plus an idiosyncratic component. If all your assets have positive exposure to the same factor, say liquidity, they will behave similarly in a crisis. True diversification means holding assets with different factor exposures. Many investors think they are diversified because they hold different asset classes: stocks, bonds, real estate, commodities. But if all these assets are driven by the same macroeconomic forces, they are essentially the same bet. For example, in a severe recession, both stocks and corporate bonds suffer because companies default. In an inflation shock, both stocks and bonds can fall. The names are different, but the underlying risk factor is the same. Let's compare two approaches. The traditional approach focuses on asset classes. You hold a mix of stocks, bonds, and gold. The factor approach focuses on risk factors. You seek exposure to growth, inflation, and liquidity in a balanced way. The traditional approach fails in crises because asset classes become correlated. The factor approach can succeed because you can combine factors that behave differently under stress, such as growth and inflation. The math of diversification is captured in the portfolio variance formula. For a two-asset portfolio, the variance is the sum of the individual variances plus twice the product of the standard deviations times the correlation. When correlation is low, the covariance term is small, and diversification reduces risk. But when correlation goes to 1, the covariance term becomes large, and the portfolio variance approaches the square of the sum of the standard deviations. In other words, the portfolio behaves as if it were a single asset. Correlation is not a constant, it's a conditional statistic that spikes in crises. The evidence from Longin and Solnik, the episodes of 2008, 2020, and 2022, and the behavior of gold all point to the same conclusion: traditional diversification is fragile. The solution is to think in terms of risk factors, not asset names. By understanding the underlying drivers of returns, you can build portfolios that are more resilient to stress. This is not just an academic exercise, it has real implications for how you manage risk. As of mid-August 2026, gold is trading around $4,437 an ounce, a reminder that even safe havens are not immune to correlation spikes. We hope this analysis helps you think more clearly about your portfolio. We appreciate your support. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.